Recording. Okay, good afternoon, everyone, and welcome to this crazy market environment, and also welcome to the second annual Women's Teach Trading and Investing 2020 Day 2. This event is brought to you by Timing Research and TradeOutLoud, and it is being recorded. David Kostner will be also posting the links for the recordings here in the room as soon as they wrap up. And both of us are going to be your hosts today. For today, we have 5 presenters. We have Samantha LaDuc, we have Mariana Villatoro, we have Ala Peters, Mary Ellen McGongle, and myself, Anka Metcalf. So Samantha, take it away.
Well, greetings. All right. We have, of course, market action, which I will want to comment on, but I want to do a little bit of a preface of, okay, who is this? Thank you very much, first of all, for the invite. I'm a huge proponent of elevating the trading space, if you will, to attract and inspire women in trading and finance. I think it is phenomenal that, Anka, you're doing this with David and coordinating it. Thank you so much. Let's see if we can raise up the voice of women a little bit and give us a little bit of time to share our approaches to how we analyze and educate and trade. So with that, my name is Samantha LaDuc. I'm the founder of LaDucTrading.com, and I am very much focused on looking at the macro to the micro, which means I pull back in time, if you will, and then identify kind of the big currents that are going to impact the smaller time frames and more actionable trades. That's my kind of claim to fame of figuring out, if you will, inflection points and market timing calls. So how do I get there? If you follow me on Twitter, maybe you saw that link and signed up for it. If you don't know me at all, then I'll give you a little bit of a rundown. I trade for a living. I do this professionally. I also support clients who do the same. Some of them are retail. They are typically not newbies. They have a very focused approach. They're either in front of the computer screens and they want my market color, real time. I run a live trading room. They want my analysis. I do extensive analysis every day, and also live commentary that they can then take and apply as they want. They might be swing traders or trend traders, and again, they're looking for kind of my feel of the market. My market timing calls are what I'm known for. So I've got some retail, but also professional institutional players, if you will, RIAs and hedge funds that are looking for that closer, they're position traders, but they're looking for that closer feel of market turns and twists. And for the retail trader, it's explaining not just what's moving, but why it's moving. So my focus, and I'm kind of known for my timing, if you will, of volatility. I'm not a volatility trader in the sense of a quant with gamma, and I'm not sure how much you know about quant, but the point is I'm using volatility as an inflection point that reprices assets. It's not very busy for oftentimes, it's suppressed. But when it does get busy, and I can tell when it's going to get busy, I am obviously calling market tops. So I actually have a better time of calling tops and bottoms, but we'll get into that. So I do chase swing and trend trade, which means I have 3 different time frames. I'm going to go into that a little bit more. Again, this is all for the purpose of serving many masters. I am looking at clients that have day trading to position trading, and I am looking at supporting their needs with, that's my, okay, Mark's getting busy, my alerts. Supporting their needs and across multiple assets. I don't focus on just oil. I'm doing this, the indices, individual stocks, currencies, commodities, interest rates, love it all, can't get enough, very curious type. And then I apply all of that really holistically to time the market on multiple time frames. So my macro stuff, if you are a follower of me on Twitter, you might see that I have a Twitter feed, and there's a lot more on the macro front than, if you have, just real quick, go here at Samantha LaDuc, you'll see that I'm much more focused on the macro themes economic releases and what they mean. The Fed, this morning, obviously, we had a huge repo infusion. And not to mention the 50 basis point rate cut, what that means, the fact that Powell didn't talk about QE, that's not satisfying the market. So I'm interpreting data that comes in, and I might give some of these sound bites, but what my clients get is everything. So I am definitely on a smaller time frame intraday, when to go long and short the SPY and particular individual stocks. Sorry, it's clearly we're having a little pullback here, clearly. So about how I do this, and I have a website that is very much a fishing theme. Okay, so I'm the captain, if you will, my trading room, my brokerage triggered trade alerts, and my newsletters. You'll find it here. You'll find out more about me, but that's basically it. I've got one product. I'm actually launching a new one, which is called Fishing Lessons, which is for those who do not want to be with me every day, or have the more kind of like sophisticated detail daily post, what I call my fishing plan, that has all the macro and the quant and the technical and the intermarket. Sometimes it's a little bit overwhelming for those who just want to kind of take my temperature twice a week. I will do a detailed webinar on what I see, where it's going, key, not only directional calls, but also stock picks, as well as the time frame and how to frame them for options. So that's my website if you are interested in checking me out. I also have a YouTube channel. It's kind of newly launched. I'll let you see that I haven't done much on that channel yet, but the more who subscribe, the more content I will provide. So the style of analysis, as I kind of mentioned, is this macro to micro. So I don't fit into a box neatly. I am eternally curious. I am a news junkie. I will teach myself macro, fundamental, technical, intermarket, sentiment. I am crazy for seeing, lawyering out a trade, the bullish and bearish kind of point, and then seeing how the market reacts to it. So for example, we had the G7 announcement this morning. It was fluff, right? There's no political action there. Market really wants political action in regards to coronavirus. Then we had a repo offering, big one, 120 billion, not little, huge. So we did 400 billion in Q4 in repo to kind of backstop, if you will, money markets for lending, which eventually will lead itself, I should say, to the leverage of hedge funds and trading desks. But for right now, they did it before the Fed even announced a surprise 50 basis point cut. That cut, it was absolutely demanded by the market, no question. You've seen rates, just be pummeled, but it wasn't enough, because as soon as Powell said no QE, no other tools in the toolbox are being considered, the market pulled back. So that's what I do real time, is how do I expect the market to react to these types of news headlines. We had the initial one where the algos took that headline and juiced the markets, and then it turned on a dime, and it's basically falling right now. And those are my VIX indicators, and Microsoft and Apple and the rest that are saying, oh, we don't like this. We wanted much more. We asked for cookies, you gave us celery. So this is what I do. Now, I have a thing, I don't know what you want to call it, mom radar. So I jokingly say that I became a volatility trader because I raised teenagers. And if there are women in the audience who understand what I mean, then you're ready to trade. This is just, if you can deal with the volatility of teenagers, you can deal with trading. That whole guardrail, okay? Don't go too far, you're gonna go over the edge kind of thing. So my focus was on, yeah, this is crazy, I can hear it right now. My focus was on trying to anticipate inflection points so that when a trend turns, right, you have not just a few minutes of it, like today, you actually, I'm looking for trend reversals that will allow for momentum and direction for many weeks, potentially many months. So even though, I'm personally not a position trader, I'm looking for the high probability inflection points. And these market pullbacks, for example, are perfect for that. And I did, which is kind of cool, put all of this energy together and time the most recent pullback, which happened to be the largest drop, you know, in a week ever. And it happened to be a call that I made on February 18th, just 3 days before a 7 sigma standard deviation move lower. And every day in my trading room, I said, don't cover. Don't cover. I see nothing. I see no volume. I see no signs of this slowing. And it was not until Friday afternoon where I said, okay, we should have a gap up on Monday of at least 2 to 3%. We ended up not having a gap up until the noontime. And then, of course, markets rallied at the end of the day, 4.5%. But the point is, this was a rubber band that had been stretched too far, and it needed to be unwound a little bit. Anyway, I'm very much into looking at timing turns, and that's what I smell. So an example of that, oh, hold, I got a question, I got to look here. Yeah, thank you, Anka. So for example, I'm a big proponent of intermarket analysis, just not price action. You already heard a little bit of that macro inflection that I'm looking for, like the Powell and the G7 announcement and the repo money. So that's all stuff in the plumbing, and a lot of day traders aren't concerned about that. A lot of fundamental traders aren't concerned about that. A lot of sentiment traders aren't concerned about that. I look at a lot of different factors, and one is intermarket, is where you compare relationships, if you will. In this particular case, I don't feel that this is going to be a V-shaped rally, and I've already, promoted that as such. But I did firmly feel we would have a V-shape last time we had that drawdown in December. It was October 3rd and December 24th. It was a 20% drawdown. And on the 12th, I wrote that we were going to have one more swoon, in other words, pullback, significant drawdown event. It actually ended up being 10%. And then we would rally in a V-shaped form, because I knew that this intensity of the pullback was so fast and furious that we would snap back. We did. Literally, in 2 months later, we had a 20% bounce. So part of this is looking at intermarket analysis, and I will show you a little bit of what I mean and compare it to what we're looking at, not specifically today, but in this market environment. One thing I'm kind of asked is, okay, market tops and bottoms. I see that typically we have, tops are a process, bottoms are an event. So I can spy a turn coming in a top better than I can a bottom. This is statistically proven. I'm better at calling tops than I am at calling bottoms. It doesn't mean I'm a bear. It just means that I have more time to spy divergences. In particular, there are divergences that happen under the surface. And if you follow me on Twitter, I even gave you non-clients on Twitter this little indication that we had massive distribution under the surface. And I wrote about it after we had gapped down on that Monday, and everyone said, oh, buy it, we're going back up. No, Tuesday, we have massive distribution. It's not getting up off the ground. We're still going down. So I can tell by looking underneath what is happening with money flow, with option flow, and with these relational studies that I do in regards to intermarket analysis. But that means I have more time in a top to find divergences. And I'll show you what I mean, but I wanted to give you that kind of background. Okay, so those are some of the tools that I use. Technical analysis is definitely important for entering and exiting a trade, but for spying when the heck that trade is gonna go, in a particular direction, and I'm a directional options trader, I am looking for everything I possibly can. Macro, intermarket, technical, sentiment, quant, I don't know. That's how I work. So my approach from a daily basis, as far as, what do I look for? Because every day I kind of scan what's going on with the Asia market when I get up, and European market and any news releases that have come in, and M&A, earnings, upgrades, downgrades, all that kind of stuff. Looking at economic releases that are coming in. We have a big one coming in on Friday, non-farm payrolls. Not a lot of talk about that right now because coronavirus is front and center. Not a lot of talk about that this morning because of the G7, Powell, and repo. But the point is, these are things that I look at so that in my trading room, I can trade up to 3 to 5 chases based on market moving news. Now, right now, we got a lot of market moving plays because the market is pulling back on the disappointment from Powell not suggesting that QE was an option. He's loath to go there. So we have also, my job, if you will, is when I do spy rotation, like I was hot and heavy for IPOs from November until the 18th of February. No joke. I did a YouTube video, said they're tired now. But that particular rotation, if you will, of money into IPOs, you'll see it on my YouTube channel. I only have a few up there, but they're all about IPOs because that was where money was going. The speculative money was for option traders like myself and my clients mostly, but also stock. The money was very much, market was going up and money was going into momentum, not just Apple, Microsoft, but also these IPO plays, cloud plays. So I spent basically all of my time fishing in IPOs from November until February and literally said, it's tired, it's done. So I'm a swing trader and I will then check those positions all the live long day to see how those swings are doing. And I'm going to show you how that is allocated because the topic of this conversation is how to allocate resources well. Big returns come when you allocate resources well. You're probably wondering, okay, where's this coming in? So that's a little bit of behind the scenes of how I come into this market mindset every day from a short, kind of myopic view to pulling out to the best swing trading plays. And then of course, spying trend reversals like I did the week before last with distribution under the surface, a sold to you market. And I was pounding the table. This is going to break. So 3 days before the market broke, I felt it, I saw it, and I warned about it. So that's what I do. Now I'm going to go on to, I was asked a question if I would define my trading style as contrarian or counter trend trader, and I would say both. Restriction is not my jam. So I know that there are consensus traders, not traders, money managers. And I have a really good, I have the FinTwit water cooler, if you will. In other words, I'm on DM with traders and RIAs and hedge fund managers and half billionaires and it's ridiculous the access that you can get with colleagues on Twitter. And I love it. One fundamentally driven RIA, long time, Twitter colleague who just was so sweet, said, I follow you for your contrarian views. And I said, I follow you for your consensus views. So he's a consensus player, but he knows that I can see when the market's getting fragile, right? And then I will look at his stuff and say, oh, well, he's like, that's a straight and narrow. It's still working. Why, so I like to do both. It depends on the time frame though, but I would say that I'm definitely not fitting into either of those. Nope, I'm just an opportunistic, analyst and trader. So this is the time frames that I wanted to kind of eke out to force, if you will, the discipline in me, but also to explain better how I analyze and trade. The chases are typically lasting 1 to 3 days. I'm not sure if yours are just intraday, for example. They might be today, for example, 10 to 30 minutes. But my point is they're typically chases and they're based on an hourly chart time frame. They are definitely, full focus because they can reverse, they can run away, they can do all kinds of things, and it gets the adrenaline going. So it is not what you'd call for the faint of heart. You got to have that kind of energy to want to chase. There's a market for that, if you will, and there's a time for that. It's separate from swings. Swings are typically lasting 1 to 3 weeks. They employ some type of strategy. You're playing Roku or whatever into earnings. If Netflix into earnings likely goes up, whatever. So in that case, these are option plays that I'm using on a monthly time frame, and they go out 1 to 3 months. So adding some time to give it some, some breathing room. And trends for me, now remember, everyone's different. You got to define your own time frame. Trends for me are 1 to 3 months. My crystal ball gets really foggy. So I do not have any idea when we're going to have a recession. Can't make it. I cannot tell you what level in the SPY we're going to close this year. Nope, not doing it. I don't make those kind of predictions. I can't see that far ahead. I'm really good, under, let's just say 3 to 6 months. So, and that's the time frame that I use for trends, and I do it on a weekly time chart. So you can see chases, I use an hourly time chart. Swings, I use a daily time chart. Trends, I use a weekly time chart. Hope that makes sense. Stocks and futures, yeah, that's basically it. Question. Okay, so this account management is very much focused on personal preference. This is mine. So I know some people trade 10% of their available book. I am a option trader, so inherently using leverage, and therefore I'm trading small but frequently. My 1 to 3% of available equity. So you got to sit with that and see if that's comfortable for you. I'm making lots of small bets. Some people make a few big bets. That's personal journey, personal preference. You know yourself. I know myself. You know your time frame, your risk tolerance, your willingness to be wrong. And more importantly, don't risk anything more than you're willing to lose. So I think that that's, for me, comfortable. Trade momentum, it means both directions. I don't care, but it's going to be a chase time frame is like 20% of available capital. And that can be quite beneficial in an environment like right now, where everything is moving together, right? Swing trades, it's a little bit different. That's kind of bread and butter. You're putting it, into a direction based on whether it's a chart, whether it's a story. Obviously, coronavirus has a whole bunch of, plays right now that are hot. They've got 20 potential vaccines, and then they've got hazmat suits and the rest. I mean, these are very volatile plays right now. They're trading like, I don't want to call them penny stocks, but they're trading like low float, small caps, because they are. But the speculation around that market is hyper, right? It's just hyper. So that's one type, I guess, of swing. But I'm talking more of a swing trade where the market or a particular stock is going in a direction. It's not, it's broken out, let's say, of the highs. It has broken support. It's bouncing, whatever you want to call it. These are swing time frames. And then last are the kind of the position or the value plays. All right, so that's account management. I hope that kind of gives you an idea. This is, did I just put that? Oh, it's the same one. Okay, never mind. I don't need that. All right, so basically my job, this is my little, intro to give you an idea of how I approach this, and I'm going to show you what's going on with how I look at the market. So my focus, in a nutshell, is I have one job for my clients, and by nature of extension for myself, I tell clients when I think it's safe and when it's not. So you can combine all the stuff, macro and intermarket and technical sentiment, quant, this is all fundamental, all that stuff. But in a volatile event, you have something called, that's not consensus anymore, right? And that's the kind of standard deviation in the middle. Lots of people are in the middle. The tail end, the tail risk, the fat risk that is inherent, innate in the market at times and reprices everything at times, better or worse, that's where I do my fishing. Okay, so that's where I really excel. So with that, that's a little bit of that volatility thing, you know, raising kids. When is it safe and when is it not? And I don't do it with a bias of politics or emotion or agenda. It's simply what I see from all those other things I just kind of talked about. And mom radar. Anyway, that's my thing. I hopefully explained a little bit of the background. As your question about futures, I'm not as crazy about them. I like options. What can I tell you? I'm more comfortable with options. They're nice for me to substitute out the capital intensive requirement of stock with more. I like the flexibility personally, and it forces me only to trade from 9:30 a.m. until 4 p.m. Eastern time. Otherwise, I think I would have a little bit too much focus on after hours. And I really moved to options because I had that kind of personality where I was looking for stuff pre-market, after hours, and slinging stock. And honestly, it eroded my quality of life. So now I can sip my tea and in the morning and look at the futures at night, and while I'm analyzing and reading, and I don't have to be trading because options are 9:30 a.m. to 4 p.m. Eastern Standard Time. All right, so let me see what else we got. We'll go to that later. So it showed you, I've got a website, blah, 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 website. Okay, where am I? I'll get there. All right, so I'm gonna show you some stuff that's a little weird, okay? Like not your run-of-the-mill, that's not a price chart. It's called intermarket analysis. And here is something that I spied. Okay, so I write a lot for clients and I annotate charts. I give them my predictions on where stuff is going in price and specifically, and then I support it with a narrative. Okay, now this is not it. This is intermarket. This is where I see some patterns emerging that then I have to keep on my radar, and then I will look for confirmation. So for example, this is gonna be a little confusing, but just recently, this weekend, in fact, waiting on a bounce. Okay, we got a little bit of one on Friday, right? End of day, we had a spike of 100 points in the last 10 minutes. That doesn't count. But I wrote this on Sunday because I was expecting a move higher on Monday, right? 2 to 3%. We got 4.5%. But in here, this is a little joke, but not really. This shows you my market, my intermarket analysis pretty well. I wish I could bring this up. Why can't I bring that up? All right, well, this is a candlestick pattern. Hopefully I can show you this. I presented this to clients back at the beginning of February 3rd. This is a cumulative 4-week new high, new low chart, literally in candlestick form. I happen to use lots of different charting and trading platforms. I know it's crazy, but stock charts, this happens to be TC2000. I can do some really great custom work that I can't do in TOS, for example. Anyway, so this was T2123. If you have this, great. If not, you can bring it up someplace else or you can ignore it altogether, but this is my job. So I noticed back in this January swoon, right? We're talking Christmas Eve massacre, that we had a morning star reversal and we shot straight up, V formation, which I was expecting because we had gone way too far. We had actually overshot quarterly support, and I expected also a MACD. Anyway, it doesn't matter. I had written about it 2 weeks before. We were gonna go one big drop and then ricochet higher. Well, guess what we got? On the 3rd, I posted this. We have another morning star reversal, island reversal. Well, here we are. This was on Friday when I took this picture. We came completely back down, and you know, with the SPY, it looks very much like this, right? So the S&P had wiped out all of the gains from the September repo and from the October breakout. So you can look on a chart And you can see, I'm going to show you just a sec. Hold on. So you can see right here, okay, this is on a weekly. All right, so this is the SPY on a weekly, and you can, maybe we had some repo here back in early September, the repo madness, then they came in, saved the market. Okay, so we broke out here from this trend line. If you're into technical analysis, this is another way to kind of low risk entry. We came right down to a 50-week moving average and a trend line. We moved not only higher, but we broke out from another weekly trend line, which happened to be from all the way back our January 2018 trounce, which only, by the way, lasted 2 weeks, but it was substantial, and it also shook a lot of people's nerves, and it took a while of sideways. Notice the chop? Right, so before we actually made it back up to October 3rd, when we had 3.2% in the 10-year, and we rolled over very strongly, and I was on that. So until the Christmas Eve massacre, and then Mnuchin calls the banks and everything's fine again, we obviously rallied. So we've taken out all of this. So if you just look at price action, there is really nothing to see here. It looked great. We were above the 10-week moving average, and I said in my trading room for weeks, all right, we broke out, we tagged the 10-week and a beautiful trend line that's very strong, right? The second time, we came right back into the 10-week moving average, again, weekly, and we were defended, looked a little scary there, gravestone doji for those who are into candlesticks, and we were quickly saved. And I said, the third time, we're gonna go through it. I will admit, I didn't expect that much through it, but once, twice, 3 times you're out, strange little trading isms I have. So we clearly broke the 10-week, right? So where could you see that? You can't see what's happening underneath the surface. So here's this 2T, 1, 2, 3. It's one of half a dozen intermarket, tells that I use, if you will. Well, it just so happened that in the same, Christmas 2018 Morningstar reversal, and then sure enough, we had a Morningstar reversal. And then on the daily, which this is, we had, you can't see it so well, we had an island reversal. Okay, so then we came up here and this was Friday, and you know the rest, right? 1, 2, 3, got it. Okay, we're down to the 200-day on the T2, 1, 2, 3, which is cumulative. I know I'm doing intermarket and it's probably like, woo, but there's a reason for why I study intermarket analysis. It's a really good tell. And this is one of a dozen, maybe 2 dozen, but there are sometimes patterns coincide. And then on Tuesday in the trading room, I said, there's no cover. There's no cover yet, because this was the biggest, and you can't really appreciate it, but let's just say I know these indicators. This particular range bar on Tuesday was ginormous. It was ginormous. These are typically little daily things. They go in a nice little direction, but they're little. That was a huge range bar. So expansion begets expansion. Selling begets selling, buying, etc. So don't cover. And we broke through the trend line, which was another, little pattern you can use. Well, I do. So my point was, is it safe? No. On Wednesday, is it safe? No, it's going to come down here. On Thursday, oh my God, we cleared right through it. So my whole contention is it safe yet? So another one that's in this same, I don't know what you call it, line, was volume, cumulative volume. Same idea. This is weekly, daily, and intraday. Take a look on this. All right, now we have a beautiful, move higher, from this volume expansion, consolidation, breakout. That's not a good look. No, that's not a good look. That's a big bearish engulfing, right? Beginning of the year, same time as this other indicator gave me a Morningstar reversal. Okay, we broke the 10-week. That's not a good, by the way, omen. You break the 10-week once and then rebound. The next time you typically go through it. And then we had this. So when I kept saying in Twitter every day, and they didn't know what I was talking about, but in the trading room they did, my clients did. I kept saying, there's massive distribution under the surface, right? And then days later, it came out. Friday, for example, 128 billion shares in the S&P were traded in one day, biggest all-time day. So that was capitulation for me, at least for a bounce. So I can use these intermarket tells the same way that many people use price action for identifying when to go in and out of Amazon, for example. All right, so that's just an example with this platform. I've got others. So I do this work every weekend where I'm really digging in to my stock charts. And one thing that I had posted, which was back on the 17th, key charts I'm watching right now, okay? And intermarket analysis is very much graphically representing relationships, strong and weak, that can foretell how the undercurrents are moving to better identify where stock, sectors, and indices are flowing. That's my thing. That's how I can smell it. So growth to value. Well, we're going to get to that. We had a big reversal in growth, but guess what? Value went down too. I was half right. Rates. Oh, we can go through all of this. The point is, this particular chart, well, we're going to go over this, came in. In other words, I warned, careful, careful. Let's go through. That was the dollar. I was bullish the dollar. We actually have since come down pretty strongly. I'm getting to something. Warning in Germany. Germany, really? It's in a technical recession. How is this going to, move higher? It didn't. It's now down here. Forget China. We couldn't short sell. Oil looked like a bounce. Yeah, that kind of stuff. All right, but the bigger one was here. Sorry, NASDAQ breadth. I was not excited that the NASDAQ, if you can see right here, kept going up, right? Huge. But look at the divergence under the surface. Okay, this is again, February 16th. These were charts I was looking at. I was not impressed with the market strength. The breadth underneath was deteriorating. I didn't trust it, and I said, I'm out. I'm out. So you had NASDAQ screaming higher, and then boom, yeah, I use Fibonacci too. All for every single chart I use it. But this is different. I'm kind of the underbelly, undercurrents of the market, right? Separate from the narrative of macro, separate from the growth case and earnings of fundamentals, and sentiment, of course, whenever you get a crowded trade, all the CTAs unhedged long, retail loading, loading in massively. Sentiment Trader did a great series of tweets and posts, clients and non-clients alike, that we were unprecedented levels of calls to puts, little protection, etc. But anyway, this was my tell that we had another reason to be worried, which was NASDAQ was screaming higher while underneath the breadth was deteriorating. That kind of work is what I do to then determine, okay, safe or not, right? So big picture, we also had this, and I did a little chart crime here. This is global money supply. Looked like a head and shoulders to me. Now, since that particular tweet and this particular newsletter for clients, yes, market pulled back, 15% on the lows. It was a dramatic 7 standard deviation move. And since then, they have just dumped global liquidity and money supply trying to reverse this trend. Hasn't worked yet. But that's the type of thing I wanted to kind of show you as far as underneath the surface. But there's always a narrative too. When this happened on Tuesday, I got really nervous. This is the Tuesday before we, had the big move last week. There was a big, POMO operation. It couldn't lift the SPY to green. VIX was above 1450. So my suggestion was long VIX above 1450. That 50-cent guy kept coming in, or gal. I actually know somebody who knows him, but this is totally not my thing. But I'm looking at going, okay, he just keeps putting lots and lots of bets on the table, whether he's hedging a portfolio, I don't care. He's in it to win it. And sure enough, tremendous quantity of VIX calls were being bid up while gold and silver were higher, dollar was higher, TLT was bid, Japan was entering a technical recession, Germany and Euro a mess. White House considering semiconductor trade restrictions. Every day it's a new kind of bear market case, but I have to see it in price action and I have to see it in intermarket as well. They all have to come together. COVID-19, of course, you know, US sanctions against Russia over Venezuelan oil. That doesn't seem like a big deal, but that is a potential escalation in geopolitics. Right now, we're totally focused on other things, but that can come back. So my point is, I was getting really nervous and I wrote, yeah, I'm anxious. I have no shorts on. Maybe that's it. So the point is, I'm looking at a whole bunch of reasons to be cautious, but none of them necessarily take the rug out from underneath a bullish narrative of price. Sorry, it can be a bearish narrative and price is still going up, but I'm looking at all the other things that can come in and create a surprise, right? So this is where I was like, okay, you know what? These IPOs are still doing awesome, but I think it's tired. I just think it's tired. I'm out. When you ask about like fib level. Oh, wait a minute. And currencies. I got to talk about currencies real quick. This is important as well. Charting, whether it be trend lines, Fibonacci, moving averages, unusual option activity, money flow. I look at it all. I am not married to one over the other. I like pattern recognition and I like divergences, right? The intermarket stuff. But one thing I didn't like was what was happening with the yen. Now this is just FXY, but it is still, it was a big deal. The dollar yen carry trade, USD JPY, was freaking higher. And that's, by the way, you know, pulling the market higher with it. So it was Wednesday. It's the last time we had the high, right? And I was like, okay, investors are selling off the yen on horrific economic data and the result of SPY, QQQ, melt up, risk on market. It most likely stops, in other words, the market from going up, most likely stops when the yen selling stops. And that was the day. So it was a 3 standard deviation move. And I wrote, it's a big deal that looks risk off, but it's actually just the opposite. So my radar for currency moves or rate moves, or I don't care what moves, it's typically when they are outsized, they then reverse. And they reverse, it's like the first move is the fake move. Does that make sense? So anyway, that was my whole thesis, that I thought we were going to have a market pullback as well that was supported by my currency read. Does that make sense? So that was what was happening right now with the dollar yen, and I use intermarket as well to kind of see patterns. This is kind of a little fancy, but the point is, as soon as we turned, the dollar also turned and came down. Anyway, that's a little bit of how I approach some of this intermarket analysis underneath. And then I write it up and I basically say, okay, here are the bullish themes. When did I write this? Hold on. Tuesday and Wednesday, my fishing club members get a fishing plan. All right, and this is Tuesday and Wednesday of the 26th, okay? So here we are. Is it safe? As I posted last night and updated today, this, by the way, was Wednesday, the 26th, last week, a week ago. As I posted last night and updated today, is it safe? I contend it is not. So what were the arguments, though, potentially, for the bulls and the bears? Because I'm always lawyering both sides. Clearly, we had a lot of promise by sell-side analysts saying, we're going to be fine. Valuations are going to be higher. We got multiple expansion and stock buybacks. We had, of course, stocks continuing to attract money, right, from the world, as there is no alternative and fear of missing out and best cleanest shirt in the laundry. We also had for sure a recurring promise of repo and POMO and, you know, Fed liquidity, but also this yield differential, which favored U.S. assets. So, but my the most bullish I could come up with really was, but maybe a technical bounce, because really I think this is just not safe. We have massive distribution. Volatility is bid. There's just nothing here that says cover. So my entire thesis, even though it was Wednesday and we had already dropped 2 days precipitously, was massive distribution under the surface indicates a very real possibility that vol targeting strategies have yet to become meaningful sellers. That's not my line. That's a hedge fund manager, a client in my trading room. And when he wrote that, mine is the massive distribution under the surface. But when he said there's a very real possibility that vol targeting strategies have yet to become meaningful sellers, I went, oh my God, he's absolutely, that's it too. So the hedge funds that had to de-risk, the CTAs that were de-risking, I could see it. I didn't have any data to support it, but I could see it under the surface with my, you know, intermarket analysis look. Not done yet was the SPY, right? And so this is how I approach and basically educate. And yes, I do fib, but it's like I said, one of the tools in my toolbox. There are many. Let me see what else here. Oh, then I give some trading, obviously, in the room, but also these, here it is. So these are sectors that had been very, very hot. Semis, the iPay, the financial cloud plays. So IGV, for example, which is, by the way, a very big component is Microsoft. I should say a big weighting is Microsoft. So these are price targets, and I expect a bounce, which, by the way, I'll do a follow-up right here. You'll see that they bounced, and now we're heading down to the pink. That's, you know, I contend we're heading down there. Was Germany a safe bet at this trend line? No. So this is what I am looking at on the bigger picture of, is it safe? All right, so we had that bounce, by the way, on Friday because we had an unscheduled statement from Powell saying, you know, we're gonna have your back, but not with any detail. But they basically warned, and then of course the market priced in the 50 basis point cut last week. So this was done even before the announcement. So we kind of forced that, if you know what I mean. The market makes the weather. The Fed is not. Yeah, they're behind. They're behind. But let's take a look at Friday, because I want to show you something under the surface that might seem a little, you know, like, how do you get this information? This is sophisticated. I can't, you know, do this. Well, that's why I do it for my clients. But the bullish data points on a Friday that would support a bounce thesis. Obviously, we had a 7 standard deviation move. That was a really big deal. But we also had, I had some data points that said, hey, we're actually tracking some strong corporate buybacks this week, right? In that downdraft, there was some pretty large buybacks going on that would help stabilize the market. We also had the largest day of buying for long, short funds since February 2018, right? So if they're buying, it can also stabilize the markets. Pension fund buying, it was the end of the month. You know, maybe that will ramp up starting today, meaning Friday, and we can get some corresponding support. The CNN fear index was registering an 8. Okay, that's extreme. It's overdone, relatively speaking. We can get some stabilization. We could get a cure, but yeah, snowball's chance it's going to be anytime soon. But the truth is, the headlines were coming out with Trump saying we're going to have a cure, and the Israelis have come up with a cure, and you know, CDC did it didn't matter. The reality is different from perception, but perception can drive algos wild. So the biggest one was we had the largest VIX spike ever. So that's why I was expecting Monday would be gap up and run. And we did sort of gap up, but not a lot. Then we ran. into the hot, hot sun, and now we're digesting that. So this is where you gotta, you know, then lawyer it out, but then what? Okay, we're gonna bounce on Monday, but then what? So not so bullish, okay? We still have CTAs that have a lot of unwinding to do. They're not as fast moving. They're trend following. So it's not like they are, you know, liquidated last week. There hadn't been really ETF outflows. It happened too quickly. Citibank said we would prefer our sentiment indicator to be closer to panic before going all in. They're not buying, so they're waiting. So there were lots of other reasons, but mostly we had a really big drop, but it was still not indicating to me that we had a lot of reversal in volatility itself in this index. And why that matters, so when VIX starts to come in, sorry, it's a school bus. When VIX starts to come in, then the CTAs, they're buying their futures and it helps bid the market. Okay, this is the game that's happening underneath the surface. My point is there's definitely a whole bunch that I put into analyzing what's going to happen next, not just a price target on a chart using fib or trend lines or whatever. So that's a little bit of a look for how I am approaching my market analysis. There's a lot of intensity, but I'm curious. I'm a curious, you know, creature that wants to understand what's moving, why it's going to move, where are the high probability trades. I don't think oil is anything more than bounce worthy and then a short, that kind of thing, right? So now we're into Monday. I'm kind of catching you up on like daily stuff, okay? Market thoughts for Monday. We had a wild futures market, which by the way is another reason I don't trade futures Sunday night. We were down 700 points and we were up 1,000 and we were down 1,000. It's crazy before we opened up in positive zone. But basically then our indices, they just sat there. There's no edge if you got no direction. There's no volume. There's no momentum. There's no playas. So hang back, right? And then boom, headline came in, real time. GC coordinated call for Tuesday, led by Mnuchin and Powell. Oh, brother. Okay, markets spiked on that news. So if you're, you know, pulling back, you know, trend or swing, you're not going to care about that. But if you're a day trader, you need to know that. That was a big, big, big deal. Now we have Super Tuesday. Okay, Biden is all of a sudden gaining, and we have this now conflict, for lack of a better word, the socialist Democrat versus the establishment Democrat. And, you know, before they're blaming the market drop on Sanders rising in the, you know, in the polls. And Predicted has no idea, by the way. Predicted is a really great kind of the betting market, poll central. And the traders have no idea how this is going to go. Volatility is not unwound, which is another thing that I had put a week and a half ago, that the skew in volatility had to be unwound for Super Tuesday. We were going to have some drama. We did. We had a really big move down last week. So where do we go from here? We had our gap up. We had 4.5%. Big picture, because I know we're coming into the end. I want to leave at least a few questions. I haven't seen many, otherwise I would answer, by the way. So if you want to put them in now, that'd be a great thing, because I get the hook in 7 minutes. Super Tuesday, is it really going to surprise, you know, Sanders with a Biden win? We already got the G7 memo, nothing. We already got Powell's pandering. Okay, got basically the market already forced him to give the 50 basis points. And we have a repo that didn't help the SPY today, did it? Now it will find its way, the leverage will find its way eventually, but my point is, this is diminishing returns when it comes to this liquidity. It's diminishing returns. And the point is, I think we're going to chop around a lot. We had a beautiful run, you know, basically from the bottom of September to the mid-February. Lots of sectors did well, not energy. But my point is, like the IPOs, the cloud, the tech, we had a ginormous sell-off. We're going to have, by the way, elevated IV, which is implied volatility in options, which is going to be ridiculously hard to work off, it's going to take a month. We're going to chop around. So this is not great time for trend traders. It's not a great time for swing traders, honestly, because of the high IV. And if you don't know sophisticated option strategies, you're at a disadvantage. Seriously. We also have coronavirus. No, I have not focused on that because it is ubiquitous and it's going to grow and it's going to create that suppression under the market, the fear, in the market as well, and keep volatility bid. But the one front and center is clearly Super Tuesday. There's another one. Hold on, let me just get to it. This one, this is Friday. I don't want to leave you with this, but I want to leave you with this. So this is a monthly chart of unemployment claims. We have non-farm payrolls coming up on Friday. Why does this matter? Because we've been in a beautiful downward trend for many, many, many years. Now you can tell this particular moving average that I have is pretty skinny. There's not a lot of buffer here. It looks like we're going to pop above and the market's already pulled back. We obviously have to have the data to support this, but this indicates to me that, we're getting there, that this trend is absolutely changing. Now we might not have it this month. We might not have a big surprise this month. We may. Coronavirus, didn't really kick into our supply chain fiasco until February, but something else is under the surface lurking. Okay, we're doing modifications, not we, the BLS, they're going back in time, the prior months, and adjusting the unemployment rate in this report. Now that might be delayed, they might not do it, but that was the news item that I had read 2 months ago, that this report would have some adjustments to prior releases, and that could facilitate a jump. It could also just be, layoffs have been picking up, manufacturing, et cetera. We are, clearly in contraction. Earnings aside, we will be moving forward the next few months for Q1. So this, I think, is going to pick up, long story short. All right, so that's a little bit of how I approach this. I hope that helps. I have, that's me, obviously. I have, oh, you asked about okay, stop loss. So options are themselves, if you will, the limited risk, right? Your risk is premium if it really goes badly. And I'm not a seller of options as much. I like finance call spreads. It's about as fancy as I get, really. And those are more for trend plays. That's where I'm buying a call spread and selling puts against it to finance it. And it's further out in time. And it's kind of like set it and forget it. But yes, you can still place an option. Now, if it's 1% of available capital, or it's a small percentage of capital you don't mind risking because you're in a chase and you're going to let it ride. And it could be it could be an earnings play. It could be a chase, whatever. You limit your risk by the amount of capital you put into it. But you can also have a stop loss, 50%, what have you. But that's a little bit more dangerous, honestly, with options. So not something I'm really crazy. I like directional options at the money. I like them when I have a thesis, obviously, with, duration of time and direction. I'm working against theta decay because I'm expecting volatility. So I'm not playing options for income, to make 25%. I'm playing options with the full expectation that this is going to be double, triple, not 1,000%. That's lucky. But I'm definitely playing volatility in directional options. And I think I put that somewhere, didn't I? No, not really. Okay, I didn't. Regarding take on gold, so I said this the other day, last week actually. So gold and miners, I have nominal real rates are obviously way low, and gold has been getting bid since rate cuts were first announced, right? So we're way high and it continues higher. And it's not just a calamity trade. It's, you know, it's a hedge right now on central bank incompetence. I'm not making an opinion. These are reasons for buying it. Mostly this sell-off last week, I saw as margin calls, not on gold, but on the books. Basically, they were de-risking, deleveraging. They had, you know, end of month, they were profitable trades in gold, and they got obviously hit on the chin with their equities. So there was this sell the gold trade. And I said in my trading room, I said, I think this is going to get defended. It's not even below the 10-week yet for gold. Also, it trades with the yen, and yen is clearly moving higher with gold. They had been out of sync, and now they're starting to get back into sync. So basically, the way I look at it,
Samantha, I'm sorry to cut you off. It's
no worries.
It's 3 o'clock now, so
I get the hook. Yes, bullish gold. Bingo. Okay. Thank you very much for your time. I think I answered questions, and I appreciate the attention. Next. Oh, and by the way, this is a promo offer.